Hello, and welcome to Chapter 8, Accounting, Decision Making by the Numbers. In this chapter, we are going to be defining accounting and describing how accounting information is used by a variety of stakeholders. We'll be identifying the purposes and goals of generally accepted accounting principles, describing the key elements of the major financial statements, describing several methods that stakeholders can use to obtain useful insights from a company's financial statements, explain the budget process and how it helps managers plan, motivate, and evaluate their organization's performance, and finally, explain the role of managerial accounting and the various cost concepts identified by managerial accountants. So what is accounting? Accounting is a system for recognizing, organizing, analyzing, and reporting information about the financial transactions that affect an organization. This is important because when you have good information, that can help you make strong and solid decisions regarding your company and the direction that it's going to head in. So how is accounting used? It's used by a variety of people within and outside of an organization. It's used by managers, stockholders, employees, creditors, suppliers, and government agencies. And who does it? There's three main groups. You have public accountants, namely CPAs. You have management accountants, which are people that work inside the firm, and they also provide internal auditing. And then you have government accountants that also review the books for publicly traded organizations. Now, an example of how a marketing manager will use accounting is they'll look at the number information to take stock of sales in different territories. So to see whether or not sales are up, sales are down. Stockholders will use accounting to learn about the financial performance of their companies. Employees use it to have discussions about pay raises and bonus issues. And creditors will use it to assess a borrower's creditworthiness. Will they, is it worth making a loan to a particular company? And likewise, suppliers use this information to confirm whether or not the company can pay them back. Most large firms will buy their inventory or their natural resources on credit, but they have to, make good on those bills. And then some government agencies that use accounting and finances include the Internal Revenue Service, which looks both at consumer and business accounting practices, and then the Securities and Exchange Commission that uses quarterly reports and annual reports to review publicly traded companies. Now, financial accounting takes a good, solid look at what the stakeholders' needs are. And they do that using what's called GAAP, or the Generally Accepted Accounting Principles. And these are industry-defined best practices that guide bookkeeping across all industries. And there is also the Financial Accounting and Standards Board, and that's an organization that the SEC, or Securities Exchange Commission, has given the authority to develop accounting rules that companies must adhere to. Now, the FASB follows the GAAP and sees to it that all financial statements contain information that will help users understand the firm's financial performance and condition. They look at the supply objective, they look to see if it's accurate, is the information verifiable, is it based on the same core assumptions and procedures across time, is it consistent? And finally, we start looking at comparables. We look at users across industries and firms over time, and do we see similar cycles? Are things matching up, or has there been a deviation for whatever reason? Now, there are three main types of accounting statements or financial statements. We have the balance sheet, the income statement, and the statement of cash flows. Now, large corporations that are publicly traded, they have to publish an annual report with all three of these statements. They also have to file quarterly reports with the SEC that also has their balance sheet, income statement, and statement of cash flows. Privately held companies will need to have this information available and as part of their bookkeeping, but not for the purpose of reporting it to the SEC. Now, on a balance sheet, a balance sheet summarizes a firm's financial position at a specific point in time. And you have your assets, and your assets are equal to your liabilities and owner's equity. So assets include things of value that a firm owns, such as cash, machinery. Anything that has a value is considered an asset. Liabilities are what a firm owes to non-owners, so any loans that have been taken out from a bank. And then you have owner's equity, which is the claims that the owners may have. So if an owner were to want to leave the company, it's how much that owner would be paid. So liabilities plus owner's equity is equal to assets. Now, an income statement summarizes the financial results of operations over a given period of time. And it's very simply revenue minus your expenses, and that leaves you with net income. Now, revenue is the increase or decrease of cash and other assets that the firm earns in a given period of time. And expenses are an assets that a firm uses to carry out the business activities necessary to generate its revenue. So expenses will include payroll, cost of materials, maybe cost of advertising, anything that is used to keep the business going. So you take your assets minus your expenses, and you're left with net income, which is your profit or loss that the firm earns in the period of time that's covered by the income statement. Now, the statement of cash flows looks at where money or cash is flowing into the firm and where is it flowing out of the firm. And there are three specific activity types that are reviewed to see how the cash flow is moving. So operating expenses, and that includes activities that show the amount of cash the company has earned from selling its goods or services. cash from dividends and interest received from ownership of the financial securities of other firms. You have your cash flows from investing activities that show the amount of cash the company earned from selling its fixed assets and financial assets bought as long-term investments. Those all fall under the investing activities banner, and you have your financing activities. So this is the cash that the firm has earned from issuing additional shares of its own stock or from taking out long-term loans. So some other statements that are included in accounting, you have your statement of retained earnings, which shows how retained earnings have changed from one accounting period to the next. So you subtract any dividends that are paid to shareholders from the net income. You need to take those out on this statement. And the stockholders' equity statement, that shows how net income and dividends affect retained earnings. So you can see changes in that when the company is issuing more stock or when they're buying back their own stock. So why do we have financial statements and their benefits? So independent auditors report. An auditor is someone who is contracted from outside of the firm, and they will review the finances of the company, and they will include that in the annual report that the company will send out to its stockholders. The independent auditors will communicate whether or not they find any problems with the firm's accounting or if everything seems above board. If there's some minor issues, they might call that a qualified opinion, stating that they're sure that the statements are fair and accurate, but there's some questions there. And if they offer what's called an adverse opinion, they do that when there is a major glitch in the firm's financial statements. So something is terribly wrong. So it's important to always check the notes that are usually included with the financial statements. So they will explain the accounting methods that the firm used to recognize its revenues, how the firm valued its inventories, and how it used depreciation on its financial statements. So it's always important to look at the fine print to find out how a company is doing. Now, trends in financial statements. When we have comparative financial statements, that's where we have financial statements that have 2 or more years side by side so that you can see how the account value changes over a particular time period. And this is important so that you can see whether or not a company is growing, or maybe sales are flat or possibly declining, depending on what is happening overall, in the overall economy. A horizontal analysis uses comparative statements to identify changes in key account values over time. So this may include your cash reserves may change, and you'll want to look at specific accounts. So the comparative financial statements are broader, and the horizontal analysis is much more specific. The SEC makes it mandatory for publicly traded corporations to present comparative financial statements. And many firms that aren't publicly traded also present these statements, even though they're not required to by GAAP. And it's just an example of a best practice in accounting procedures. Now, budgeting. Why would a firm budget? Well, just like your own budget at home, you want to have an idea of how you're going to acquire and allocate resources to achieve your goals. And it's the same for a company. Budgeting helps to specify how the goals will be achieved, and it encourages the coordination between managers throughout a firm, that they're all working towards the same goal. It can be highly motivational, and it helps to evaluate progress and performance in a firm. So top-down budgeting, there's a couple of different ways to budget. So top-down is where upper management or the board of directors prepare a budget, and they very seldom ask for input from middle management or from supervisory managers, and they then share that information or those budgets with those managers and supervisors without their input. Now, bottom-up budgeting has both middle and supervisory managers participating in the creation of a budget. So what they will do is, for those managers that oversee an entire department, they will look at how much money do they need to operate their department, and in return, how much will their department contribute to the company's bottom line. People who support the bottom-up budgeting feel that the middle and supervisory managers are more familiar with the difficulties that their department faces and the resources they will need to handle difficulties. A challenge with this, however, is that it does take more time in order for this budget to be built and moved up through the corporation. And time is money, so it does tie up some resources to do that. Now, parts of a budget, we have the operating budget, which is your projected sales and production goals and how much it will cost the firm to meet these goals. You have financial budgets that focus on the firm's financial goals and identify resources needed to get these goals. So under this particular area, you have your cash budget, you have your capital expenditure budget, which is maybe the purchase of new equipment, and then your budgeted balance sheet. At the end of that time period, how will your assets match up against the liabilities and stockholders or owners' equity? And finally, you have your master budget, which represents the firm's big picture plan for how they're going to financially operate over, usually it's a given year. So this is an example of a budget document that's used to prepare a master budget. So we start with the sales budget and we continue to move down through the system where we have, if we look to the left with the production budget, we have direct labor, how much it's going to cost for our employees, how much will it cost for our materials under direct materials, and then overhead. That's the lights, the cost of running the facility. All of these come together to form the budgeted income statement. So we have our production budget, then we have the sales group on the other side. And from the budgeted income statement, we can build the budgeted balance sheet. So there's a lot of work that goes into these budgets, and every successful company will have some sort of budget to help them keep track of whether or not their business is being successful or not. Now, a static budget is based on a single assumed level of sales, and it's probably not the best budget type to use. And the reason for that is real world sales can vary considerably from their forecasted value. And there can be a problem it's a problem because it's not I'm sorry, I'm having a mental moment, so I appreciate your flexibility here. Static budgets, the problem with them is that they aren't valuable in evaluating performance and identifying problem areas. That's what I was trying to say. So a flexible budget, on the other hand, can help managers overcome disadvantages that are presented by static budgets. And you can make effective comparisons between actual costs and budgeted costs. So looking at what you were hoping to have come in and spend, and then what reality was. And personally, I have found those to be very effective. So we have two different types of accounting here. We have financial accounting and managerial accounting. And these next two slides are going to highlight those. Managerial accounting is designed to meet the needs of a firm's managers, and depending on the purpose of the accounting budget, that will determine the type of information that is presented, the types of reports, the timing, and the adherence to accounting standards and the time periods. So under financial accounting, it provides information to external stakeholders and is generally available to the public. As far as the information that financial accounting has, it's almost exclusively financially driven. You won't see market information. And under financial accounting, there's a prepared standard set of financial statements. Compared to managerial accounting is really designed for employees and internal stakeholders, so your management teams. And this information is proprietary and is not public. It does provide both financial and non-financial information. So you might have information on market share and what your overall sales goals might be. And under managerial accounting, you have customized reports that deal with specific problems or issues. You may have a particular project that has its own budget that you wouldn't see in a bigger report that you are reporting out to shareholders. And finally, as far as the timing, financial accounting, these reports are presented quarterly and or annually. There is a set of generally accepted accounting principles, and they really focus on past performance and the impact on the firm's present conditions. Whereas managerial accounting, it creates reports by request or on request by management. It uses procedures that are developed internally. And the reports deal with past performance while making projections about the future, particularly when planning for future projects and future product launches. So, managerial accounting and accountants' concepts. So, we look at, under managerial accounting, out-of-pocket costs. So these are actual expenditures of money or other resources that are needed for a particular project. There are implicit costs, which these costs are incurred when the opportunity to use an asset in an alternative way is given up. Let's see, an opportunity cost an example of one might be the wages that a company pays its workers and the payments that it makes to suppliers for raw materials. Those are opportunity costs or implicit costs. So fixed costs are costs that don't change regardless of what the company does or how they handle production. Some fixed costs include interest on a bank loan or property insurance premiums. Those insurance premiums will be the same whether you use your plant or not. And then you have variable costs, and these change depending on whether or not the firm is producing more goods or more services. And some examples of variable costs are labor, supplies, utilities. Now, direct costs can be directly traced to the production of the product. So we have wages that can be traced to production line and cost of materials that go directly towards that product. We have indirect costs, which include the costs that a firm incurs for plant maintenance, quality control, or depreciation on office equipment. And then there's activity-based costing, which identifies activities that create and factors that drive indirect costs. These costs are directly tied to the production of that particular product or service. And it's usually easier to assign and measure these types of costs. So this is just a very, very top line view, 10,000 foot view of accounting. We've defined accounting and described how accounting information is used by a variety of stakeholders. We've identified the purposes and goals of generally accepted accounting principles, or GAAP. We've described the key elements of the major financial statements. We've looked at several methods stakeholders can use information to gain insight about from a company's financial statement. We've taken a look at the budget process and how it helps managers plan, motivate, and evaluate their organization's performance. And finally, we've taken a look at the role of managerial accounting and the various cost concepts identified by managerial accountants. So please, this concludes our lecture for Chapter 8. Please go to Buzz to see the assignments that have been assigned for this chapter. There is a quiz, and you should be getting prepared for your next exam, which is coming up shortly. Thank you very much, and I hope you have a great day.